Thank you so much, Brendan, for that kind introduction. Good afternoon. It's a real pleasure and privilege to be here, I have to say. At the time I agreed to come and give the talk, the plan was to come and talk about lessons from the UK's financial crisis. Over the period since, you've had your own. So it could be much of what I'm going to say is now going to be painfully familiar. Certainly there are some common roots to the problems that the UK went through 07, 08, in which Ireland has been going through over the most recent period. I want to talk a bit about those common roots today, but also about what might be done to head off a repeat performance. Because part of the story I want to tell is that although we've had this time's crisis, it's there, it's with us, this is in some ways just the latest in an evolutionary sequence of crises. And that evolutionary cycle needs somehow to be broken. So I want to talk a bit about policies that might break that evolutionary crisis cycle. So that's the plan. But to provide a bit of context, let's just scale what we've been through and how bleak it has been for the world economy. These are a few metrics of how much has the crisis really cost the world as framing. Well, one way of thinking about that, one metric might be by how much did output fall in the world as a result of the Lehman's failure and the surrounding events. And that number is big. That number is big. So world GDP down 4 or 5%, around $4 trillion. You can make a guess for a bigger number. Here's a bigger number. By how much did banks' market capitalization fall globally, peak to trough, as a result of the crisis? That's a bigger number. That's around $5 trillion. Let's not stop there. If you totted up how much money was thrown at the problem by governments in the form of capital injections to banks, in the form of liquidity assistance, in the forms of guarantees of various types. We're still counting, of course, that number. But the running score is around $15 trillion. I haven't stopped. If you looked at a different metric again, I'm not sure what's happened there, dropped off the bottom, which is by how much wealth has been lost across a broad spectrum of assets. I'm not sure if you can see that on the screen. The mark-to-market wealth loss, peak to trough, is more like $25 trillion. That's about almost half of world GDP per year. And if you, something's gone wrong with this, but if the number you can't see would have been by how much do we think output, both now and in the future, may have been lost. What we know from crises is that output falls to begin with, but often never returns to its prior path, or at least if it does, it takes a long time. If you totted up that loss of output over time, the number you'd be talking about would be somewhere between 50, 60, and $200 trillion, a multiple of world GDP, this time round. This is a vast amount, and this is what makes the case for us needing to do something different. So what has driven this problem? What have been the root causes of these types of cost? I should have said at the beginning, by the way, as I work for the official sector, I have to say that these views aren't necessarily those of the Bank of England, but they might be. Two root causes I want to talk about. One is the credit cycle, the slings and arrows, the ups and downs of credit, which we've seen the world over. The second is the so-called too big to fail problem. The first is a conjunctural thing, It happens cyclically over time. The second is a structural feature of the economy. I want to tell a story about those two root causes having generated crisis. I want to tell a story about those two roots having combined to generate a particularly big crisis this time round. How the structure of banking has evolved, naturally, it's evolved such as to amplify the cost of the credit cycle. Ireland, of course, is as good a case study of these two things combining as any I can think of, as is the UK, as is Iceland, as is the US in some respects. Many examples around the world. Here are some, here's just a picture of credit growth, the most recent credit cycle for some of those countries. Ireland in the blue, selection of others, not quite randomly selected these, Greece, the UK, Spain and Portugal. In each case, what do we see? We see a synchronous long boom punctuated by a synchronous fall to earth in the growth of credit. That's been the most recent cycle, but it's one that we've seen repeated through history. So here's some longer term pictures for the UK and the US. Excuse me using those examples, but the data is sometimes longer run. So that the red line here is the cycle in credit. The blue line is the cycle in output in GDP. What would I ask you to conclude from this? The cycle in credit is every bit as much a regularity as the cycle in business, in income, in GDP. Except it's bigger. It's bigger. So on average, at least at the UK in this example, the cycle in credit is at least double that you typically find for the business cycle. And its duration is often longer term as well. So a typical business cycle, 3 to 8 years. The typical credit cycle, 8 to 15 years. And that mirrors pretty well what we've seen in the UK and Ireland over the course of this century. Cycles in credit, cycles too in asset prices. The blue line now is still GDP, but the green and purple ones are respectively equity and house prices. Again, what do we see? We see a regularity in the cycle stretching back over decadal spans. We see the amplitude of that cycle being even greater than that in credit. So if the peak to trough in GDP is 10 percentage points, that in credit is roughly 20 percentage points. For house prices and equity prices, it's more like 30 or 40 percentage points on average over long sweeps of history. And these booms and busts in credit and asset prices have very clearly, historically, have foretold of impending crisis. So more often than not, when these booms happen, the consequence down the road, whether it's 1 or 2 or 3 years down the road, is a crisis. These statistics speak to that, whether it's an exchange rate crisis or a banking crisis or some combination thereof. These swings typically end in a crisis of some type historically. You might ask the question, so why is it? Why do we get these booms and busts, these swings from over-exuberance to over-pessimism? What's the story? What behaviourally is going on? And I think certainly during this time's crisis, indeed in many previous ones, what we saw behaviourally was a keeping up with the Joneses type problem. So take this picture here. It looks at the ratio between the market price of banks' equity and the book price of their equity for a selection of banks internationally, some European ones, some US ones, and some UK ones. What are the takeaways from this? Well, this ratio of market to book from 1990 onwards went on a bit of a party. We had a 20-year party in banking, basically, which only ended with a crisis when this ratio fell back to earth where it started the 20 years previously. And a second striking thing here is the degree of correlation in these lines. This was a party that was taking place in pretty much every country in the world, at pretty much the same time, in pretty much the same amounts. There was a collective mania as everyone got caught up in needing to keep up with the Joneses, whether that Jones, whichever bank was leading the pack at that time, was leading others into the same sorts of business in the same sorts of amounts. So you probably remember back in 2007, when the then CEO of Citibank said, look, if the music's still playing, you need to get up and dance. We're still dancing. That captures, in a way, the mindset of the time. You can't afford to sit out this party. Everyone was partying, and anyone who didn't get up and dance was left behind. Of course, the CEO in question didn't last much longer after that comment, but nonetheless, the dynamic was important to generating these types of collective manias. Let me skip over that. And these manias, because banking is a competitive industry, weren't just national, they were international. So this picture, the left-hand side picture, looks at the degree of correlation of credit across countries. How correlated is the credit cycle internationally? The red line is the most recent period, the blue is the period before that. The takeaway is that the credit cycle is increasingly an international phenomenon, not just a domestic one. So who was it that was generating all this credit? Who were the lenders? Who were the key lenders? And here's where we go from the credit cycle to too big to fail. Because what this chart does is asks whose balance sheet expanded most during the most recent credit cycle. Was it the big banks, the medium-sized, or the small ones? And the answer is it's the biggest who were contributing most to this boom, and indeed subsequent bust. And in terms of who they were lending to, that chart is tricky to read. It hasn't come out terrifically. What it basically shows, all the green part here, this shows the expansion in balance sheet, and the green part of this chart is that part which was lending not to real businesses, households and companies, but rather to other parts of the financial system. So this ballooning in balance sheet wasn't lending to the real economy, it was intra-lending within the financial system as it became increasingly dense and interconnected. Here's a picture that speaks to that, complicated one. The dots are countries, the blue lines are the flows of funds between the banking systems in those countries. Don't need to be able to read the names, but the picture as you move through from 85, 95, 2005, 2008 is of an increasingly dense thicket of interconnections within the system. A furball of banking interconnections by 2008 as they were lending to one another. This was the origins of too big, too interconnected to fail. What I want to show now is just how radical a shift in the structure of banking we've seen viewed over a century span. What are the key diagnostics? This looks at the average size of a US bank in relation to the economy. It pretty much flatlined from the 1930s up to the 1990s, and since then has grown by a factor of around 4 in a generation. US banks are much, much bigger in relation to the economy than they were a generation previously. The pattern is mirrored in most countries around the world, certainly in Ireland, in the UK, in Spain, in many others. Not just big, but concentrated. This picture looks similar, but now looks at what share of banking is accounted for by the three biggest banks. It flatlined from the 1930s to the 1990s in the US, and then rose by a factor of 3 or 4 over the course of the past generation. Same picture could be drawn for Ireland, for the UK, for Spain, for other countries. A structure of banking that's bigger, that's more concentrated, that is debt propelled. This picture doesn't appear to have come out, but what it would have shown is that the capital ratio of banks in the UK and the US has fallen dramatically over the course of the last 100, 150 years. So back in the 1850s, if you were a bank in the US, your capital ratio, the amount of equity on your balance sheet, was about 50%. By the time of the crisis, that had fallen by a factor of around 10 to 5% everywhere in the world. So this growth in balance sheet is debt propelled, not equity propelled. Leverage increased astronomically. And at the same time, the assets banks were holding on the other side of the balance sheet were increasingly of an illiquid form. This looks at the ratio of liquid to illiquid to total balance sheet. So again, back up no further than the 1970s. And banks in the UK internationally might be holding as much as 20, 30, 40% of their balance sheet in a liquid form. For example, in government securities. By the time of the crisis, that ratio had fallen by a factor of 10 in a generation to more like 2 or 3% of their balance sheet. So you combine a structure of banking that's big, that's concentrated, that's interconnected, that is debt propelled, and whose assets are increasingly illiquid, and the consequence will be crisis. And the consequence in this case was not just crisis, but bailout. This just looks at how much of an implicit subsidy was being provided to banks ahead of and during crisis, in this case in the UK. What are the key takeaways from this picture? That implicit subsidy from government that comes from the expectation of them riding to the rescue was very significant. Let's just take 2009, which is the biggest bar in the UK. The implicit subsidy to UK banks in 2009 was around £100 billion sterling, which is roughly what we spend on our National Health Service. Within that, the lion's share, overwhelmingly, is accounted for, as you'd expect, by the big banks. The implicit subsidy was garnered most by the banks that were largest, as you'd expect, because they know if they were to fall under a bus, that government would be there to pick them off the floor, as indeed happened and has happened in pretty much every country around the world. So the story, which in a previous paper I've called rather pessimistically the doom loop, or I'll leave you with, is of an evolutionary equilibrium, okay, in which you combine these structural features like size and leverage and illiquidity and concentration. That generates you a crisis, the like of which we've seen. Government is forced to ride to the rescue, to provide a safety net. But just think of the incentives that gives rise to if you're a big bank. That in turn generates, call it moral hazard, call it misaligned incentives. What it does generate is an incentive to get bigger still, to get yet more concentrated, to become even more debt propelled, to take on even bigger asset bets by investing in liquid stuff rather than liquid stuff. So that next time around, the moral hazard could be amplified. I'm not sure if it's squared or cubed or what the right reciprocal is, but it's going to be bigger. That much is guaranteed. And in a sense, what we've seen over the course of the last 100 years or more, perhaps 150 years, is of this repeated cycle, credit cycle, but which latterly has been given an amplifier by the structure of banking. And having lived through this crisis, that structure, if anything, has moved in the wrong direction in terms of the costs of next time's crisis. That's the prognosis. It's a gloomy one, but it makes the case for sure for us thinking about how best to prevent a next time, given how costly this time has been. So what are the two dimensions of policy? How do we break this cycle? How do we reverse this doom loop? What tools are available to us as the policy community to prevent a repeat performance? I want to discuss two. They're both regulation, but they're quite different in their orientation. The first is so-called micro-prudential regulation. And the second is, and the new kid on the block, is so-called macro-prudential. Let me talk to both in the time that remains. Starting with micro-prudential. So here we've had action, okay. So over the course of the last year or two, since the crisis, during the crisis, we've seen this Basel Committee, on which I sit, draw up new plans for how banks should be regulated, so-called Basel III. Took us around 2 years to come up with an agreement, which was reached at the end of last year. 2 years sounds a long time. In regulatory terms, this is warp speed, okay? So Basel II, its predecessor, was 10, 15 years in the cooking, and the cake was effectively never eaten. So this is real haste. It's a technical agreement, but in essence, what it's trying to do is simply described. It's about more of the same, but better, okay? So this is more capital for banks, but this time, the quality of capital will be better. It's about more liquid assets for banks, only this time will be of a better standard. And it's about more regulators, but this time they'll be smarter. And if that sounds jolly familiar, it should be, because it's the same thing we say after every crisis, okay? The trend has been towards more regulation, more regulators, only this time they'll all be better. It hasn't been a conspicuous success this time round. I think there must be some misgivings about whether it'd be a success next time round either. So if we're rethinking whether this is adequate, this is certainly progress, but is it sufficient to forestall a next time? I think we need to back up and ask whether the regulatory framework we have is adequate or needs a tweak. And my line will be that it might benefit from a tweak. If we think about the existing regulatory apparatus and evaluate it on a set of criteria, is it simple? Is it understandable? Is it robust to getting things wrong, to just not knowing? Is it timely? Does the framework give us a cue for corrective action promptly? And I think it can be argued that the existing framework falls somewhat short of meeting those objectives. So for example, let's just look at this. The complexity of the Basel Agreement. Basel I, so-called, the first vintage, if I was calculating a capital ratio for a bank, I could do it in my coffee break on the back of a cigarette packet, okay? Around 7 calculations. Let's fast forward now to Basels 3 and 4. This is going to have to be a really long coffee break and a really massive packet of cigarettes to fit all of this on. It's become fiendishly complicated in a way that's very difficult often for the market to make sense of. Now, of course, complexity by itself isn't a bad thing if the new rules were offering more timely signals of impending doom. This picture just looks at the capital ratio of 2 sets of banks. The red are those that basically went bust, that needed intervention. The blue was those that fared okay. The striking thing here is there's almost no difference, actually, between the capital ratio of those that failed and those that survived. If anything, the capital ratio of those that failed was higher than that of those that survived. So as a timely warning, the current framework isn't quite doing it. If not this, then what? Well, I think there's a case for thinking about an instrument on banks' balance sheets that is both simpler and offers more timely warnings. It's these things called COCOs, stands for Contingent Convertible Securities. What they do basically is when a bank runs into the buffers, that debt instrument converts into an equity instrument, okay? So the bank is automatically recapitalized if it runs into the sand. And if you combine that with a trigger for conversion that's based not on regulatory ratios, but on the market prices of that bank's securities, you have, I think, a much better chance of acting promptly ahead of impending doom. This picture speaks to that. It looks at not the regulatory ratio as calculated, but instead the market price of crisis banks, that's red, and non-crisis banks, that's blue. A market evaluation of how much capital they have. And as you said, there's now clear blue water between the stricken and the non-stricken. And the signal offered by stricken banks is pretty prompt. It's 6 to 9 months ahead of the Lehman's crisis in October 2008. So there's a chance here that by combining this new instrument with a more market-based approach to signaling, triggering its conversion, we could get simplicity and prompt corrective action all rolled into one. In a way, what you get then is that a bank automatically recapitalizing itself if it falls on stony ground. Now, a question would be, okay, you've just magicked an instrument that does the trick. What gives you any confidence that anyone will want this instrument? You know, where's the demand going to come from for this COCO? And my answer to that is you can create demand for this by distributing these securities to your shareholders and to your staff instead of using cash. And that's a double bonus. So you pay your staff, or you pay some of your staff in COCOs, and you pay your shareholders in COCOs. What does that do? It does two things. One, it keeps the money in the business. It boosts your capital ratio. How much? Quite a lot. Left-hand side picture. Had UK banks, instead of paying bonuses in cash, and instead of paying shareholders dividends in cash, had they paid out half of those in COCOs instead, their capital ratio would have been the red or the green line rather than the blue one. I.e., it would have been much, much higher than we saw ahead of crisis. It might even have averted crisis. So one benefit of doing it this way round is that the bank is on average much more resilient, much less likely to fail. And the second benefit is that it lines up incentives. Because what these COCOs do, that their payoff profile means that in the good times you get paid, and in the bad times your claim gets diluted. So you bear the downside risk of your actions. That will make both shareholders in banks and staff in banks much more risk sensitive, much less likely to bet the ranch next time round. That's enough on microprudential. Let me just finish up on macroprudential, which in some ways I'd say is the new thing. And it's new because what it aims to do is tackle those twin demons I mentioned at the beginning, the credit cycle and too big to fail full on. This is becoming practical reality. over the course of the last 6 months, internationally, we have put in place frameworks, committees, institutions explicitly charged with doing this. So in the US, we have this thing called FSOC, the Financial Stability Oversight Council. It met for the first time in November last year. Within the EU, we have this new creation, the European Systemic Risk Board. That meets for the first time today. It's meeting for the first time as we speak today. In the UK, we have our own committee, the Financial Policy Committee, which will come into being during the course of this year. Each of these new bits of institutional apparatus are about executing this new thing. So what is this new thing? How might it best be done? Well, on taming the credit cycle, what this new box of tricks aims to do is to smooth out those fluctuations in the credit cycle that I mentioned at the beginning, those age-old booms and busts that we've seen across all developed countries for a century or more. How does it do that? Well, a variety of ways of doing that. If you look across Asia right now, the way some Asian central banks are doing that is to lower the amount of lending that banks can do relative to the value of property, to set loan-to-value ratios. There are other ways of doing it. You could raise the amount of capital that banks have to hold during booms to choke off the supply of credit. Here's a nice 3D picture that shows how that might have worked. So 2000, 2001, the boom takes hold. You start raising capital to rein in the exuberance in credit. Had this apparatus been in place in Ireland, in the UK, elsewhere around the world, it's plausible that the credit boom may not have got out of control in quite the same way. The second of the twin evils was tackling too big to fail. Again, a variety of ways of going about tackling that. One way is to ask the biggest banks to put more aside for a rainy day, to hold bigger buffers of capital. Why? Because we want to lower their probability of failure, because we know that they are super spreaders. We know, going back to the epidemiological example that Brendan mentioned at the beginning, that we know that when those big guys go down, the collateral damage is that much greater because they're connected to the whole world. That was the Lehman story. Given that, we need to lower their chances of going down in the first place, which calls for bigger buffers of capital for the bigger or more interconnected. That's one thing that could be done ahead of time. We need also, however, to prepare ourselves for getting it wrong. Sometimes big banks will make bad bets and will fail. And in that event, we need to ready ourselves to deal with the consequences. What are the proposals on the table here? Well, one would be that when that happens, we don't want the bill being footed exclusively by the taxpayer. We'd prefer the burden to be shared with private creditors who are there, after all, to put their money on the line for just these sorts of events. So there are proposals out there. The European Union issued a consultation paper just a week or two ago for proposals for so-called bail-in debt. That is, instruments that write into them the provision for them to be haircut, written down, in the event of a bank hitting stress. So that the slack is taken up, not by the taxpayer, as now, but by private creditors who are meant to be putting risk capital in and therefore should bear some of the risk of that capital. There are also plans to, if a bank is to fail, we need a plan. We need a way of decomposing it so that the good bits remain upright and functioning. For example, deposits. So the big bank fails, you want depositors to be reassured their money is safe. Otherwise, you get a Northern Rock type experience, which is terrible for everyone. You need the good bits to be preserved and the bad bits to be wound down. That calls for a plan for how you pull apart a bank in the event of the worst happening. That's these so-called recovery and resolution plans. They're living wills. They're explaining what will be done if death comes to a big interconnected bank, such as not to blow the world up in the way that Lehman's did. That takes us on to broader questions of the structure of banking. Maybe we can discuss some of that in the Q&A. There are ongoing initiatives here in the UK, in the US, across Europe, to think about whether we've got the right industrial organisation of banking. Let me wind up. The costs I've spoken to mean that both literally, from a financial perspective, and metaphorically, we can't afford to have a repeat performance of that we've seen over the last year or two. We will see government debt ratios across the Western world double in consequence of this crisis. We can't afford another doubling. That calls for breaking this crisis cycle, this ever amplified crisis cycle that I've dubbed the doom loop. I've mentioned the progress that's been made and more speculatively mentioned one or two of the initiatives, further initiatives that might be needed to break that doom loop. It's a problem that we've all felt up close and personal for the last year or two. And I'm looking forward to hearing your questions and our discussion of whether this is the right sort of direction of travel. Let me stop there. Thank you.